Hi, my name's Tim Parker, and I'm the incoming manager of the T. Rowe Price Global Natural Resources Strategy. I'm taking that over on June 30th, 2010, from my longtime colleague Charlie Ober, who's retiring after a storied 30-year career here at T. Rowe Price. This is one of the oldest natural resources strategies in the sense that it's been around for over 40 years and was one of our founders' first three strategies. Thomas Rowe Price himself founded the strategy, and it's currently just under $7 billion in management. Now, if you're watching me, you might be wondering, why invest in natural resources? And I personally think this is a good opportunity to invest in natural resources because commodities are driven more by the fundamentals of supply and demand than virtually any other sector. And right now we're in a period where industrialization of emerging economies is driving demand sharply higher than usual at a time when supply has been comparatively constrained. And when supply and demand come together in a tight fashion, you tend to have rising prices of commodities rising faster than either the rate of inflation rises or the pace of the market's appreciation in a broader set of asset classes like broad equity market stocks. So the way you've achieved this is that after being very much in vogue in the 70s, natural resources experienced roughly 2 decades of underinvestment because while returns were great in the 1970s, that brought in a lot of capital, a lot of investment, a lot of new supply came on, just in time for it to overwhelm the market and demand to collapse. And so returns became very poor in commodities in the 80s and 90s, and people stopped investing. And so after that 20 years of fallow fields of little investing, supply started to dwindle and be naturally depleted. And at that same time, emerging economies began to industrialize. Principally China, that's the single biggest consumer of commodities in terms of commodity growth. But it's also important to note that the former Soviet Union, particularly Russia, the Middle East, and Asia ex-China is also growing quite fast in terms of per capita GDP. And when emerging economies move from a few $1,000s per capita to several $1,000s per capita GDP, the pace of expansion in commodities consumption rises exponentially. So with tight supply, rising demand, you've seen a good time to invest in commodities throughout the course of the 2000s, and I think we're on the cusp of another leg of that story. In terms of how we do this at T. Rowe Price, we have the benefit of a large global team. So I'm the portfolio manager for this product effective June 30th, but I have the benefit of portfolio managers like Charlie Ober who've gone before me, who've taught me well and continue to advise me. But I also have a team of global analysts. A number of my team, my global metals analyst, for example, is in Baltimore, but I have analysts in Buenos Aires, London, Hong Kong, Singapore, really throughout the globe to support our investing process here. And that is a differentiator between a large firm such as ourselves with an experience in this field as opposed to some smaller competitors. This allows us not only to source ideas globally, but to look at a range of commodities, from oil and gas to metals to agriculture, coal, paper products, etc. And so we think our global team gives us a lot of benefits that a smaller firm may not have. Further, this differentiation in terms of the ability to diversify gives us a naturally less volatile stream of performance. And so we tend to behave like other natural resources strategies, but with a little less volatility, particularly in comparison to pure energy or precious metals strategies. So to talk a moment about our process, we start really with defining the universe as commodities, within one, move up or down from a commodity itself, meaning I might want to own an oil producer or an oil driller or an oil refiner. And so stay true to that commodity investing, but be able to move across the value chain because at different points in a cycle, different parts of the value chain tend to be better exposed. For example, in a time like now, when prices for commodities are generally high, you may have noticed that for oil prices or metals prices, it is better to be within the servicing part of that equation, the upstream part that helps to find new oil or develop new mines because there's a lot of spending on those efforts. So once we define the universe, then we really start top down, looking at all the sectors and figuring out what are the best places to invest. So what commodities have the best supply and demand fundamental balances that will make them the best places to invest over the next few years. Then we apply our bottoms-up analysis, which is really a hallmark of T. Rowe Price. All of our products feature strong company-level bottoms-up analysis, and this product is no different. And we marry that top-down focus with that bottoms-up review to find the best ideas in a given commodity orientation, whether that's oil, gas, metals, etc. And so that then leads us to find what we think are the best companies from this bottoms-up analysis, and they often have characteristics like strong management with a good sense of how to reinvest capital, low-cost production streams, long-lived assets, and we always hope we can marry that with a compelling valuation. And so we find those best ideas and bring them together in a product that is somewhere around 100 names, really globally oriented, not simply in terms of where these stocks are listed, but in terms of the drivers of these stocks. It very much hinges on global markets, particularly emerging markets, no matter where the listing of the stocks. And so it really is truly a global fund in that sense. And in terms of diversification, we are more diversified than many of our competitors because we do diversify across a range of natural resources sectors, keeping us a little less volatile, but we do enjoy strong leverage to these markets as well. So to close on where we're positioned today, we have bets laid down in energy a little heavier than we might normally, both oil and gas as well as coal, because we see tightness, particularly for oil supply, in the next couple of years. And as I mentioned earlier, we're a little heavier levered to servicing companies because we see a lot of spending in that area. But we also have strong bets laid down in coal, both thermal coal and metallurgical coal, particularly because international markets for thermal coal are very tight because India is quite hungry for coal but is short their net requirements, and China is increasingly outsourcing their production of coal to foreign lands as well. And then finally, one differentiator is the fact that we invest in agriculture, in fertilizer companies or seed-related companies, because we see the same drivers of increased commodity demand used for metals or oil drive demand for grains as well, because diets tend to become richer in calories and in protein as per capita income rises, and that leads to inordinate increases in grain consumption, because to create 1 pound of beef protein you need 8 pounds of grains to feed that animal. So in summary, the T. Rowe Price Global Natural Resources Strategy is a way you can invest alongside these trends in emerging markets, which are driving commodity prices higher as supply remains constrained over the next few years. And I view this to be a good time to invest in this area, particularly as the next few years unfold. Investing with T. Rowe Price in this product gives you the opportunity to invest along an experienced franchise. We've been doing this for over 40 years, a broad and stable team. We have roughly a dozen analysts that work on this product across the globe. Gives us broad access to a range of commodities and a truly global mandate. And we do have the sense that this will be a good time to invest in commodities to an effect that would not only outperform most broadly diversified equity markets, but will likely outpace inflation as well. So it can be a good hedge against inflation. Thank you very much.